Carnival Cruise reported quarterly financial results, and there were some important items that investors should consider. Of course, I've had Carnival stock rated as a buy all year, and I'll update this recommendation in this video, let you know what I think about the company after evaluating the latest quarterly results. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. Of course, before diving into these current results with the cruise ship industry, it's important to remember during the pandemic, this industry was absolutely devastated. There was a big question mark if most or any of these cruise ship companies would survive in their shape that they were in prior to the pandemic. Carnival surprisingly came out of that and is now thriving. So, despite having the cruise ship shut down for many, many months, surpassing even a year in some areas, the company survived. But there were certain changes, including a much larger debt balance. So it's important for the company to generate profits and cash flow more so than ever. So this quarter, they achieved an all-time high of net profit of $2 billion. That's really impressive, surpassing their pre-pandemic benchmark by nearly 10%. So this company now is generating more profit than it was before the outbreak. That's impressive, especially because now they have a lot more debt and a lot higher interest expense, as the management team notes here. They have nearly 600% increase in net interest expense compared to 2019 on a unit basis. The debt levels are even more meaningful because the company borrowed this money at a time of desperation when their cruise ships were shut down and they were bleeding billions of dollars. Imagine going to a lender in that type of situation. Do you think the lender is not going to try and charge you super high interest rates? Of course they are, and they did. And so Carnival borrowed nearly triple. So before the pandemic, it had roughly $10 billion in debt, and that nearly tripled to $30 billion in debt in the aftermath of the pandemic. So it borrowed an incremental $20 billion at very, very high interest rates in desperate situations. And so this profit the company's earning is helping them pay down that debt, the highest cost debt, and thereby lower this interest expense, which then increases the cash flow, and they can have a positive virtuous cycle for many, many years as they pay down this debt. It'll take them time. They're not going to be able to pay down this debt in 1 year or even 2 years. It's going to take them time, and they're heading in the right direction. So yields increased 4.6%, and all of which was achieved on a same ship basis. So there's more people on average going into their ships, and of course the prices are much higher than they were before. So that's what's driving the improvement in profitability. More people taking cruise ship trips with Carnival, and then they're paying more money per person, and they're spending more money when they're on board, all of which is benefiting Carnival Cruise. They delivered a return on invested capital of 13% for the trailing 12 months, which is solid, and I expect this to continue increasing as they continue generating increasing revenue per customer, while their costs remain relatively flat. Their leverage is now down another notch to 3.6 times net debt to EBITDA, and I forecast they will continue using the cash flow they generate to pay down a lot of that debt. I highlighted earlier, they still have over $20 billion in debt, and the interest expense on this debt is relatively high. So they can keep paying this down, and as they pay that down, it'll lower the interest expense, generate even more cash flow, which they can use to pay down debt, and they can keep that cycle going for many, many years, because I'm estimating the company will generate roughly $3 or $4 billion in free cash flow over these next few years before rising to around $5 and $6 billion in cash flow in 2029, 2030. So when you're thinking about a debt of around 30 billion and you're generating about 3 or 4 billion in free cash flow, that's going to take many years to pay that down. They're not going to pay all of that debt down. I'm thinking they're only going to pay down the bulk of the debt that they acquired during the pandemic because that was when they had to pay the really high interest rates. The debt they had before the pandemic is not very high debt and not very high interest rates. And so there's no urgency to pay down that debt. But the debt from during the pandemic is urgent for them to pay it down. So the intrinsic value per share, I updated this calculation today, is $11.51, I should say. The current market price is $28. So it still looks undervalued significantly at current market prices. So I updated my buy rating on Carnival Cruise Line today. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.